Hello, I'm David Wright and I'm a Technical Officer at the Association of Taxation Technicians, or ATT for short. Today we'll be looking at some tax issues that can crop up for those on higher incomes. This video will be most relevant to employees earning £50,000 or more but who don't complete tax returns. We'll give an overview of a few things to think about, but for more detail you might need one-to-one advice. You can find an ATT member to help you out by visiting att.org.uk and using our Find an ATT service. There's no one-size-fits-all definition of high earners, but for the purposes of this video, we'll start off by looking at a couple of points that higher rate taxpayers might need to think about. We'll then go on to look at some extra complications affecting people with income of £100,000 or more. When we talk about earnings, we're not just thinking about your salary. The tax issues we'll be looking at in this video depend on your total taxable income. That includes not only any employment or self-employment income, but also investment returns like interest or dividends, as well as profits from renting out a property. Let's look at some common tax issues for higher rate taxpayers. For the tax years ending 5th of April 2024 and 5th of April 2025, anyone in England, Wales and Northern Ireland with taxable income of more than £50,270 will normally pay higher rate tax on any income above that amount up to around £125,000. For earnings and savings income, that means a 40% tax rate applies, rather than the basic rate of 20%. Scotland sets its own tax rates and bands, so if you're a Scottish taxpayer, those figures will be different. As an overview, for the tax year ending 5th of April 2024, Scottish taxpayers pay higher rate tax at 42% on income between approximately £43,000 and £125,000. There will also be a new 45% advanced rate of tax in Scotland from 6th of April 2024 on income between £75,000 and £125,140. You can check the Scottish Government website for full details or get professional advice locally. For simplicity, the examples in this video are based on the English and Welsh rates of tax. If you pay into a pension scheme or donate money to charity, as a higher rate taxpayer, you may not realise that both of these outgoings can reduce the amount of tax you have to pay at the 40% rate. When you give money to charity and make a gift aid declaration, the charity can claim extra money from the government to top up your donation. But you can also benefit by claiming higher rate tax relief, meaning you only pay 20% tax on part of your income, which would normally be taxed at 40%. The amount of income which qualifies for this relief is calculated as your gift aid donation multiplied by 1.25. So, if you donate £100 through gift aid, you'll save 20% tax on £125 of your income. That saves you £25 in tax for every £100 you donate through gift aid, as well as allowing the charity to claim an extra £25 from the government on top of your donation. To claim the tax relief, you can either contact HMRC and ask them to adjust your tax code if you're an employee, or if you file self-assessment returns, you can claim the relief by including your gift aid donations when you prepare your tax return. Tax relief for paying into a pension scheme can be claimed in a similar way, but you'll only need to claim relief if you pay into a personal pension fund or if you're an employee making contributions to your employer's pension scheme under what's known as relief at source arrangements. You might need to check with your employer how your pension contributions are deducted from your pay, as other arrangements give full tax relief up front, which means there's nothing further for you to claim. One final point for higher rate taxpayers with children to think about is whether the high income child benefit charge affects them. From the 6th of April 2024, if your income is over £60,000 and you or your partner claim child benefit, you might need to repay some of the child benefit you receive each tax year. The threshold before 6th of April 2024 was £50,000. We've made a separate video looking at the high income child benefit charge, so check out our YouTube channel or the videos section of our website if you want to know more. Tax gets more complicated if your income reaches £100,000. One important change at that level of income is that you start to lose out on the personal allowance, which is the amount of income you don't have to pay tax on. For the tax years ending 5th of April 2024 and 5th of April 2025, the personal allowance is £12,570, but you lose £1 of that allowance for every £2 of income you have over £100,000. So if your income is £110,000, your personal allowance is restricted by £5,000, leaving you with just £7,570. If you're an employee, this adjustment should be taken care of through your tax code, but it's worth checking it to make sure any restriction to your personal allowance is correct. We've made a separate video on how to check your tax code, which you can find on our YouTube channel or through the videos section of our website. If you file self-assessment returns, the amount of personal allowance you're entitled to will be taken into account when working out how much tax you have to pay each year. It's important to understand what makes up the income which is tested against the £100,000 threshold to work out how much personal allowance you're entitled to. The amount you're trying to find is called your adjusted net income. It starts with your total taxable income, but that figure needs to be adjusted for things like gift aid donations and pension contributions, either to personal pension schemes or those made to an employer scheme under relief at source arrangements. You can find more information on how to work this out by going to gov.uk and searching for adjusted net income. We've looked in this video at a few common tax issues for high earners, but there may be other points you should consider too. If you think you might be affected by anything I've talked about today, bespoke advice can be really valuable to understand what you're entitled to and to make sure you pay the correct amount of tax. Speaking to a qualified tax advisor can have other benefits as well, helping you to plan for the future whilst making sure you do everything you need to with your tax affairs. As a reminder, you can find an ATT member by going to att.org.uk and searching under Find an ATT at the bottom of the homepage.